Friends, Ethereum has already proven that it's the true king of altcoins. It broke its level and confirmed its strength. And now it's Solana's turn. We see how institutions are beginning to pay attention to this asset, how the ETF story is reaching its final stage, and how all of this could change the game for Solana in the coming months. In this video, I'll share my price forecasts, explain what to expect next, and most importantly, which projects from the Solana ecosystem I personally consider as interesting portfolio picks. Friends, before we move on to the market review and then to the promising coins, please note that this video is not financial advice. It only reflects my personal impressions and assessment of the market. Always do your own research and invest wisely. Now let's talk about Solana in detail. In recent weeks, this blockchain has once again become the center of attention, and not only because of the price growth. The situation is more interesting and deeper than it may seem at first glance. Let's start with the main thing: institutional interest. If earlier Solana was often mentioned as an Ethereum killer for retail users and projects, now large players are actively looking at it. The reason is simple: the rapid rise of liquid staking. Now funds and companies can not only buy SOL and wait for the price to grow, but also effectively deploy it in protocols, earning yield while staying liquid. This is another level of use, not about speculation, but about financial strategies that institutions are familiar with. Yes, this isn't the main factor behind the recent price surge, but it's precisely these gradual trends that make SOL more attractive for funds in the midterm perspective. The second important point: Pantera Capital. They are launching a $1.25 billion initiative to create a public company in the form of a Solana treasury vehicle. Essentially, this means Solana officially begins to enter corporate balance sheets, becoming similar to instruments from traditional finance. If earlier such initiatives were associated only with Bitcoin and Ethereum, now SOL is joining that league. This can be seen as an important signal of growing trust. Now let's look at the on-chain metrics. TVL in the Solana ecosystem has exceeded $13 billion for the first time. This is a record, and it's important for several reasons. First, it confirms that users and projects are not just playing around with the blockchain, but are actually storing liquidity there. Second, it means Solana has become a serious competitor in DeFi, as such liquidity opens doors for the development of new products, from lending to asset tokenization. And one more crucial factor: ETF. It's no secret today that several applications for Solana ETF or ETF-like products have been filed with regulators. They envision the possibility of integrating staking directly into ETF. If this scenario goes through, it would be a huge breakthrough, as traditional investors could access SOL as an asset and additionally receive potential annual yield in the range of 3 to 5% through staking. This is a powerful argument capable of attracting billions of dollars into the network. It's also worth mentioning partnerships. Not long ago, the Solana Foundation announced cooperation with Bullish aimed at creating institutional-grade stablecoins. This is not just another token in the network. We're talking about settlements, payments, and custodial services that have every chance to become the backbone of financial applications on Solana. This is a step toward real adoption in the broader economy. As for the price, right now SOL is trading in the $230 to $250 range. This is a consolidation zone after strong growth. In any case, after such a surge, a cool-down phase always comes. But if we talk about forecasts, given ETF approval and the continued pace of ecosystem growth, Solana could well test $280 to $300 and even break higher. And what's important? Solana is no longer just a fast blockchain. It's gradually becoming a tool for institutional investors, for funds, for companies that want to hold SOL on their balance sheets. When we see news about the creation of treasuries based on Solana or its integration with PayPal's infrastructure, it shows Solana is positioning itself as a fundamental player in the future financial system. So overall, the picture looks like this: record TVL, strong interest in liquid staking, initiatives from large funds, ETF news, and partnerships with global companies. This doesn't look like short-term hype, but like a gradual, systemic story with long-term potential. And before we move on to the review of promising altcoins from the ecosystem, make sure you subscribe to the channel. I've been emphasizing Solana's potential for the last 2 years. I already mentioned that I reviewed Solana when it was still at $70. But even just a little over a month ago, I made a video about Solana and its ecosystem. Since then, the coin has grown by 50% in just 1 month. So if you don't want to miss things like this, hit subscribe. Friends, today we continue exploring interesting coins from the Solana ecosystem. And one of them is quite a loud project of recent weeks. World Liberty Financial, WLFI, connected to Donald Trump's family. The project launched very recently, on September 1st, 2025. Alongside the launch, the WLFI token and the USD-1 stablecoin appeared, fully backed by US Treasuries and the dollar. World Liberty Financial positions itself not as just another meme token, but as an infrastructure project with its own economy, governance system, and buyback and burn mechanics to make the model deflationary. There are already some headline moves. ALT5 Sigma announced the creation of a $1.5 billion crypto treasury, half of which will go into WLFI. The USD-1 stablecoin is being integrated into trading platforms like Flipster to be used as a digital dollar. On paper, everything looks ambitious. But scandals weren't avoided. One of the biggest investors, Justin Sun, claimed his $75 million stake was unfairly frozen. The project has restrictions. Early investors can only sell up to 20% of their tokens. This immediately raised questions about transparency and centralization inside WLFI. What about the price? After launch, WLFI quickly pumped but has now fallen more than 50% from its highs. Liquidity is still unstable, with the chart forming key zones at $0.20 to $0.25. Some see this as a bounce opportunity, while others say it's still too early to enter. Forecasts vary, from 30 cents to 60 cents in consolidation to a potential $1 by the end of 2025. Still, caution is needed. If we recall previous Trump-branded crypto projects, their history wasn't too bright. The difference here is that WLFI is trying to position itself as a serious player in the RWA segment, using political and corporate background to build trust. They're aiming at the real-world assets market with their own stablecoin and ecosystem. That's why we don't put it in the shitcoin category, and we'll closely watch how it develops. Now let's talk about another loud project in the Solana ecosystem, Pump.Fun. If you follow meme coins, you've definitely already heard this name. So what is it? Pump.Fun is essentially a meme coin launchpad on Solana. Anyone can create their own meme token for a small fee, and then the ecosystem mechanics kick in: trading fees, incentive rewards, and most importantly, buybacks that support the price of the main token Pump. How does it work in practice? A share of the revenues from fees and token launches is directed to buy Pump from the market. This is the key factor, because after the ICO, the token's price crashed from a $700 million market cap to around $260 million by late July. The reason is obvious: early allocations, weak liquidity, and a general cooldown in meme coin hype. But the team responded aggressively. The buyback program has already exceeded $62 million. Every day between $1.3 million and $2.3 million is spent on buybacks. Imagine, over 16.5 billion Pump has been repurchased at an average market cap of $380 million. Part of these tokens are burned, part are used for rewards. And this created a safety net. Below a certain level, the price just doesn't want to drop. Now we see recovery, plus 190% from the lows, rising trading volumes, and the return of trader confidence. On top of that, marketing and listings only amplify the effect. What about prospects? On one hand, Pump has real hype potential. The buyback model, community support, and focus on meme economy. If the wave of interest in memes continues, we could easily see another surge. But let's not forget the risks. Demand here still depends on retail investor sentiment, and if buybacks suddenly weaken or can't be funded from fees, the whole model starts to wobble. Plus, there's always the regulator factor, who may view meme coins as risky financial instruments. So friends, pump looks flashy and loud right now, but it's a game for those who understand the risk. It will definitely be fun, but whether it will be stable, that's an open question. Friends, next let's talk about Pyth Network, a project often called data for the entire blockchain. What is Pyth? It's a decentralized oracle system that supplies blockchains with market data, from stocks and currencies to macroeconomic indicators. Unlike traditional oracles, it uses a pull model. Data is requested only when it's actually needed. This reduces costs and makes feeds more up-to-date. Why is this important? Everything connected to DeFi, derivatives, lending, even algorithmic trading works only when there are reliable and fast prices. And here, Pyth has become a key player. More than 600 protocols across 100-plus blockchains have already integrated its data, and the number of feeds has exceeded 1,800. What's new? The biggest headline: cooperation with the U.S. Department of Commerce. Through Pyth, key U.S. economic data, like GDP or PCE, is now available on-chain. This is a move beyond DeFi experiments, a step toward integrating government data with blockchain. Second, the institutional monetization strategy. The team is launching a development phase aimed at attracting major financial players. This means not only DeFi traders, but also banks, funds, and asset managers. Plus, integration with companies like Ozak AI, which now uses Pyth data across more than 100 blockchains for its solutions. Why is this interesting for investors? Essentially, Pyth is a bet that the project can establish itself as one of the key standards for market data in crypto and beyond. If you're running a protocol for lending, derivatives, or asset tokenization, you need reliable pricing. And the more real integrations there are, the greater the demand for the token. Forecasts vary. Analysts talk about the possibility of seeing 30 cents or higher by 2026 if the institutional integration trend continues. But there are also risks. Large token unlocks have already pressured the price, and this factor hasn't disappeared. Final point: Pyth today is not just another oracle. It's a platform that is already bringing U.S. macroeconomic data on-chain. If this direction continues to grow, Pyth has the potential to become an important market data standard in the new financial system. Friends, the next token we'll talk about is Ether. This is one of the most prominent representatives of the DPIN sector. More specifically, decentralized GPU computing. And here's the important part. Ether is betting on several markets at once: AI, gaming, and Web3. What does this mean in practice? Ether is building a global network of computing power where any GPU can function as a node, from data centers to edge devices. The entire system consists of cloud hosts, checker nodes, and edge GPU units. The fuel of this ecosystem is the ATH token, used for payments, incentives to providers, and network governance. Now to the news. A major mainnet upgrade is scheduled for the fourth quarter of 2025. This isn't just an update, it's expected to reduce latency, boost performance, and expand multi-chain functionality. In simple terms, users will be able to access GPU power more easily and cheaply from any blockchain. The second key point: partnerships. Arizona State University received $3 million in grants for AI computing, a signal that Ether is already working with real educational and research projects. Together with Credible, the project launched a DPIN credit card where ATH tokens can be used as collateral for stablecoin loans. A collaboration with iExec opens the door to confidential AI computing, where privacy and data protection are crucial. What's interesting for investors? Ether already reports more than 1 billion compute hours, a metric that proves the infrastructure is working in practice. There's also a strong economic edge. The project claims potential savings of 40 to 90% compared to traditional cloud providers. The ATH price has also been moving. Over the last 30 days, the token has nearly doubled, reaching a $167 million market cap. And this comes amid expectations of the upgrade and the growing global demand for GPUs in AI. What's the outlook? If the upgrade is successful and demand for decentralized GPU computing continues to rise, Ether has the potential to establish itself as one of the key players in the DePIN segment, especially in AI training, gaming, and real-time rendering, where speed and reliability are essential. But as always, there are risks. It's still a young market, competition is strong, and much depends on whether Ether can maintain its growth momentum. Well, that's all for today. Remember, these are just my personal thoughts on the market, not financial advice. Always do your own research before making any investments. Thanks for watching. Don't forget to subscribe, hit the like button, and stay tuned for more coin reviews. See you next time.